Elon Musk just dropped the date. Tesla earnings are in 72 hours. Will you be a spectator or a strategist? One wrong move can wipe out gains. The right move can double your position overnight. I get that sounds dramatic, but I trade these events for a living, and today I'm going to lay out a simple, repeatable, 3-step playbook that professional traders use to handle Tesla earnings with an edge. No guessing, just rules. Let's go. Most retail traders do one thing. They buy calls or puts and hope. That's not trading, that's gambling. My goal in this video is to give you a framework to prepare, specific strategies to use, and non-negotiable risk rules so you don't get blindsided. Part 1. The pregame. Trading earnings starts days before the print. If you want an edge, you must know what the market is actually watching. There are 3 key metrics I always check. Metric 1. Tesla's delivery numbers are the most reliable pre-earnings indicator. These show real demand. I look at the consensus expectation that Wall Street publishes, then compare it to Tesla's last quarterly deliveries. If deliveries are rising, but Tesla is offering big incentives, that's a red flag. A revenue beat can exist with profit margin erosion if discounts are hiding behind volume. Metric 2. The official EPS estimate is often noise. The true market expectation is the whisper number, what big traders quietly expect. Sites like Whisper Number aggregate this. If Tesla's reported EPS beats the published estimate but misses the whisper, expect disappointment. A beat on the whisper number is far more market moving than a beat on the book estimate. Metric 3. For Tesla, automotive gross margin excluding regulatory credits is the single most important line. It tells you whether price cuts are sustainable. Rising deliveries with stable or expanding margins is a green light. Rising deliveries with collapsing margins is a severe warning. I always build scenarios. Best case, base case, and downside case for margin outcomes. Part 2. The strategies. Warning up front, buying shares or straight calls or puts immediately before earnings is high risk. If you must trade on news, use structures that control risk. Here are the 3 strategies I use depending on my bias and risk tolerance. Strategy 1. Implied volatility, or IV, is the market's price for uncertainty. It spikes before earnings and collapses afterwards. That collapse destroys the value of bought options. So the pro move is to sell expensive options, not buy them. The short strangle does that. I set it up. Number 1, sell 1 out of the money call. Number 2, sell 1 out of the money put. Number 3, collect premium up front. Profit if Tesla stays between those strikes. And why it works? You're selling expensive insurance into a high volatility environment. After the report, volatility collapses and the options decay fast. Important, a naked short strangle can have large risk if the stock explodes in either direction. I only sell a strangle if I have a plan to manage a move or I convert it into a defined risk structure mid-event by buying wings. Strategy 2. When I have a directional edge but want defined risk, I use an iron butterfly or a butterfly spread. You're selling premium in the center and buying protection on the wings. It reduces max loss while still benefiting from volatility crush and a stock that stays near your target. How it works? Simply sell the body at the strike you think Tesla will gravitate to, buy wings to cap risk. You get credit up front, and you know your maximum loss before the print. This is my go-to when I'm directionally biased from deliveries and whisper numbers, but don't want open-ended risk. Strategy 3. Sometimes the smartest trade is to sit on your hands during the chaos and trade the reaction next day. Let the options and algos overreact. Set an alert. If Tesla gaps up and holds above a key resistance level 45 minutes after open, I buy. If it gaps down and breaks support, I short or buy puts. You avoid volatility crush and trade real market conviction, not headline emotion. Part 3. Risk management. These are hard rules. Break them and you will lose. Rule 1. Never risk more than 1 to 3% of your total portfolio on a single earnings trade. Let's do the math cleanly. If you have $100,000 in your portfolio, 1% is 1% of 100,000 equals 0.01 times 100,000, which equals 1,000. 3% would be 0.03 times 100,000, which equals 3,000. That means your potential loss should not exceed $1,000 to $3,000 on that trade. Rule 2, before you enter, calculate the worst case outcome. An uncovered short strangle can be devastating. If you sell premium, have a plan to trim or hedge if the stock moves beyond a set price. Rule 3, Decide your exit rules in advance. Example, I will take 50% of profits at mid-target and I will close the trade if my paper loss hits a preset number. You must remove emotion. So, to recap, step 1, analyze deliveries and margins and check the whisper number. Step 2, choose a strategy. Short strangle for volatility crush, a butterfly to get direction with defined risk, or wait to trade the reaction. Step 3, manage risk like your career depends on it, position size, no max loss, and set exit rules. Which strategy will you try for the next Tesla earnings? Tell me in the comments and I'll respond to the best ones. If you want to trade with this level of precision every week, hit the like button, subscribe, and turn on notifications. We break down complex moves into simple plays every week here at Elite Trade Club. Options and earnings trading are risky. You can lose your entire stake. This is educational and not financial advice. Do your own work, and if you trade, keep the risk small.